Listen intently. The old gods of finance are dying, and the majority of you are still standing at the altar. For 50 years, the bank was the only answer. You give out your control, your trust, and your purchasing power in exchange for a false promise of security. That period is dead. This is the Zenith Voice, and we are here to offer a single, undeniable truth. Your money is either a tool you command or it is a captive you risk losing. This audiobook is not about speculation, it's about sovereignty. We will reveal the hidden fee of safety, study the harsh logic of Bitcoin's scarcity, and push you to answer the only issue that matters. Where should your money actually live? The time for passive engagement is over. The learning begins now. Chapter 1. The Security Lie. What your bank account really is. Welcome to Chapter 1. The instant you heard the title of this book, one question burnt in your mind. Where should my money actually live? For decades, you have been taught the default answer. You've been conditioned to believe in a hallowed financial truth. The bank is safe. The bank is secure. Your money goes in the bank. This is the first falsehood we are pulling down. The bank account you rely on is not a stronghold for your wealth. It is a lease arrangement. It is a loan you extend to the institution, and it comes with a devastating hidden price tag: your control. The illusion of delegation. You deposit $1,000. You see it on your app. You believe it is your 1,000 bucks sitting there waiting for you. You are wrong. When you hand the cash to the bank, you complete a financial transfer of ownership. That money is no longer literally yours. It becomes a liability on the bank's balance sheet, and you receive an IOU in the form of a deposit account balance. This is the cornerstone of the fractional reserve system. They receive your money, and they promptly lend most of it out. They are practically gambling with your principal. They rely on the statistical certainty that not all of you will ask for your money back at the same time. This is not security. This is a confidence game that relies on your passivity. You have confused delegating with safety. You have outsourced the accountability of your money to a business whose primary, legal, and single obligation is to its shareholders, not to you, the depositor. Control is the only safety. Repeat the phrase. Write it down. Internalize it. Your money is unsecured debt. Let's explore the cold, hard math of your connection with the institution. When a firm issues a bond, it is debt. When you deposit money into a bank, it is no different. You become an unsecured creditor. If the bank fails, you stand in line. Yes, the Federal Deposit Insurance Corporation, the FDIC, is there. It gives coverage up to $250,000. This generates an emotional cocoon of warmth that encourages complacency. But ask yourself, who backs the FDIC? The government. Who prints the money the government uses to support the guarantee? The central bank. What is the underlying problem with money printed by a central bank? Its worth is not assured. Its supply is endless. If a systemic catastrophe hits, a true crisis, not a tiny regional bank failure, the only way for the government to fulfill those pledges is to print additional money. That is called dilution. That is called inflation. Your funds will still be there, but their value will be annihilated in the process of their retrieval. The safety you rely on is in fact a hidden mechanism for value deterioration. It is the illusion of security obtained at the expense of your purchasing power. Instruction: the brutal audit. The time for soft thinking is finished. We must perform a severe, honest audit of the agreement you now possess. Instruction 1. Find your real rate of return. Open your bank statement. Look at the interest rate you receive on your savings. Most of you will see a figure floating somewhere around 0.01%, or possibly, if you are lucky, 0.5%. This is your advertised return. Now, let's find your real rate of loss. You must recognize the facts about inflation. Official government data are altered and often deceptive. Look at the costs you actually face: housing, food, healthcare, and education. These are the things that matter. For this audit, we will adopt a conservative, real-world inflation rate of 5%. Take your savings balance. For every year you keep it in that account, you are basically paying an invisible tax of 5% to retain it. Your 0.5% interest is pointless. Your true net annual loss is 4.5%. You are not saving, you are witnessing your wealth slowly, reliably flow off year after year. The bank is not a savings vehicle. It is a guaranteed depreciation vehicle. You must quit behaving like a passive victim of this system. Control is the only safety. The sovereignty shift. The greatest threat is not market volatility, it is the utter certainty of the system's deterioration. Bitcoin was established expressly to overcome this problem of delegated trust. It takes the power of the central bank, the ability to generate money at will, and substitutes it with an immutable, verifiable computer protocol. This is not an argument for rapid gains. This is an argument for financial sovereignty. You need to transform your thinking from depositor to entrepreneur. When you retain Bitcoin in a wallet where you control the private keys, we will address this in detail later, you eliminate every single layer of risk we just discussed. No fractional reserve, there is no lending mechanism, no unsecured debt. The asset is yours, verified on the public ledger. No dilution risk, the supply is mathematically capped at 21 million. This needs a mental toughness that most individuals simply don't possess. It demands self-responsibility. It necessitates action. It demands that you stop relying on the comfort of government-backed fiction. Your bank account is a crucial utility for daily life, for paying payments, for immediate liquidity, but it is not and never has been a solution for storing or expanding your wealth. The difference between the bank and Bitcoin is the difference between a renter and an owner. Choose to own. Choose to be sovereign. Control is the only safety. You have faced the truth of what you are now doing wrong. Now we must grasp the corrosive factor that is making your correct decisions obsolete before you even make them. You've explored the fiction of security. Now let's talk about the math of thievery. Chapter 2. Accept the inflation tax, the invisible leak in your net worth. You realize the lie of security. You know your bank account is an IOU and a liability for the institution. Now, we advance to the next layer of truth, the most ruthless, efficient, and unavoidable drain on your wealth. It is not a cost. It is not an expense you can cut. It is a systematic, government-sanctioned annihilation of your purchasing power. This is the inflation tax. You must stop regarding inflation as a natural economic weather pattern. It is not raining. It is not snowing. Inflation is a policy, not a phenomenon. It is the direct effect of decisions made by unelected central bankers and politicians. It is stealing by design, and you are footing the tab. The mechanism of theft. How does this tax work? Through the simple act of producing money. When governments spend more than they collect through taxes, they issue debt. Who buys that debt? Often the central bank. How do they pay for it? They produce fresh cash digitally out of thin air. This is termed quantitative easing. Every additional dollar pumped into the system dilutes the value of every existing dollar. Your stack of cash becomes a slightly thinner stack of cash. No one gives you a bill. No one knocks on your door. Your net worth simply evaporates, quietly, silently, year after year. This is the invisible leak in your financial foundation. It is the sneaky tax on the responsible saver. The painful math of passivity. We are going to make a cold, hard calculation. This is not for motivation. This is for transformation. You need to look the beast in the eye. Let's pretend you have been disciplined. You have achieved a huge financial milestone. You have saved a six-figure sum, $200,000. and you have picked the default path. You have left this capital in a typical low-yield savings account or a certificate of deposit. We shall not use the currently falsified government inflation figures. We will use a cautious, real-world estimate based on commodities that genuinely matter to you: housing, education, and energy. We shall utilize a stable, non-negotiable average yearly inflation rate of 3.5%. Now, look at the grim reality over 1 decade, 10 years of financial inaction. Year 1. Your $200,000 still shows on the screen, but its purchasing power has plummeted by $7,000. Year 5. The cumulative loss is severe. You have forfeited over $38,000 in purchasing power. Year 10. After 1 decade, that original $200,000 has the buying power of around $141,600 today. You lost over $58,400 simply by doing nothing. You lost the price of a fancy car or a down payment on a second property. You toiled, you saved, and a central authority dissolved your effort. That is the cost of trusting a system founded on perpetual expansion. That is the price of believing the myth that your savings account is a secure store of value. It is not a store. It is a siphon. Inflation is a policy, not a phenomenon. You cannot control the policy, but you can manage your exposure to it. The sorrow of confronting the $58,400 loss should fuel your decision. That money was stolen from you by a policy you didn't vote for and a mechanism you didn't understand. Understand now, the biggest risk is the illusion of safety. The true cost of remaining still is significantly larger than the perceived risk of taking control. You must be aggressive in safeguarding your personal fortune because no one else is. You have finally acknowledged the math of financial deterioration. You understand that inflation is a planned tax on your effort. Now, we must address the final psychological obstacle that keeps you trapped in the old system: the need for approval. You must quit asking for consent to use your own money.
Chapter 3. Stop being a financial hostage. The cost of permission. You have seen the lie of bank safety. You have computed the cost of the inflation tax. Now we must uncover the greatest, most humiliating vulnerability of the old banking system: the cost of permission. Every time you move your money, every time you conduct a transaction, every time you send funds over a specific limit, you are asking for permission. You are a financial hostage. You hold the account, but you do not hold the keys. You have delegated your financial freedom to a third party, and that third party, the bank, the payment processor, the government, always retains the authority to say no. This is not a theory. This is the reality of censorship danger, asset seizure, and arbitrary constraints. Permissionless finance is the ultimate freedom. The single point of failure. The existing system is built on intermediaries. It is a hub-and-spoke model. Every dollar must pass through a central clearinghouse. Every transfer requires confirmation and permission. This central authority is a single point of failure. Think of the controls they wield over you right now. Withdrawal limits. You cannot simply access all your capital when you desire. You must adhere to their daily limitations. Transfer delays. Wires take days. Funds are retained for security review. Account freezing. A simple flag, an erroneous report, or a political decision might quickly shut you out of your whole net worth. You are guilty until you prove yourself innocent. When they lock your funds, they are not protecting you, they are asserting their influence over you. Your money is collateral for their power. You must cease assuming that centralized efficiency surpasses personal sovereignty. It does not. The transient convenience is compensated for with the constant risk of utter financial immobility. Permissionless finance is the ultimate freedom. The behavioral shift from client to controller. To escape financial captive position, you must accomplish a comprehensive behavioral and psychological adjustment. You must go from being a client of a service to being the controller of your own riches. This is the shift to non-custodial finance. When you retain money at a bank, it is custodial. The bank holds custody. They approve of the movement. When you use Bitcoin and control your private keys, it is non-custodial. You hold custody. You approve of the movement. This change requires you to execute two things immediately. Instruction 1. Embrace the key. You must set up and master a non-custodial wallet, a digital location where only you own the secret keys, commonly known as the 12 or 24-word seed phrase. This is the tough love moment. When you control the keys, you eliminate the single point of failure. But you also bear ultimate accountability. If you lose your seed phrase, your money is gone. No bank to call, no password reset button. If you divulge your seed phrase, your money is gone. No one to blame except yourself. The vast majority of people refuse this obligation. They enjoy the gentle comfort of delegating. They are not ready for sovereignty. You must be different. You must embrace this load, since it is the price of true ownership. Instruction 2. Utilize decentralized exchange. Your accumulation timeline must use platforms that minimize custodial time. When you buy Bitcoin, the asset must travel directly from the exchange and into your non-custodial wallet. The exchange is a vital bridge, but it is not a home. If you leave your assets on an exchange, you are still granting them authorization. You are still exposed to their terms, their hacks, and their freezes. Stop making trades with your bank. Get in, buy the asset, get out. Fast. Ruthlessly emphasize self-custody. The power of permissionless transaction. Think about the global power of Bitcoin's design. When you send a transaction, you do not ask the government of your country or the bank in your city or the processor on your phone. You present a cryptographically signed request to the network itself. The network checks the signature and the balance. The miners confirm the transaction. The transaction happens. Permission is not necessary because the entire system is designed to be trustless. You do not need to trust the recipient. You do not need to trust the bank. You merely need to believe in math. This is a fundamental philosophical shift. It means your ability to transact cannot be prevented by a dictatorial government, an aggressive lawsuit, or a bankrupt institution. Your money moves when you decide it moves, not when they decide. This is the financial equivalent of self-defense. You must be armed with your own keys. Every day you delay this shift, every dollar you leave in custodial hands is a dollar you are voluntarily handing up to censorship risk. Do not be the financial captive waiting for rescue. Be the sovereign who has the fortress key. Permissionless finance is the ultimate freedom. The instant you accept custody, you cease being a captive. We have highlighted the degradation of the old system. We have defined the price of authorization. Now, we must turn to the unassailable technological truth that makes this whole transformation worthwhile. The math behind ultimate scarcity.
Chapter 4. The 21 Million Wall. Understanding Scarcity as Value. You have shattered the illusion of safety. You have computed the cost of the inflation tax. You have understood the humiliation of asking for permission. Now we turn to the absolute truth, the unbreakable premise that supports Bitcoin's existence: scarcity. The primary innovation of Bitcoin is not a digital currency. It is a digital limit. Bitcoin is the only asset in history where the whole supply is known, verifiable, and mathematically capped. There will only ever be 21 million coins, no more, not one unit extra. This is the 21 million wall. It is the singular, hard-coded foundation upon which every unit of Bitcoin value is built.
You must stop viewing Bitcoin as volatile speculation. You must begin considering it as verifiable scarcity. Scarcity produces assurance. Certainty is worth it. The power of the hard cap. When you hold $1, you are holding a promise. That commitment can be violated and diluted by a policy choice made tomorrow by a handful of people in a room. The supply of dollars is endless, regulated by the political and economic needs of the moment. When you have Bitcoin, you are holding a mathematical proof. The protocol, the rules of the network are meant to actively fight inflation. The genius is not the technology. The genius is the discipline. The supply schedule is coded into the DNA of the system. It functions on a predictable, non-negotiable mechanism called the halving. Instruction: compare the mechanisms of supply. We must now compare the two competing supply mechanisms, fiat money versus the Bitcoin protocol. Mechanism 1. The fiat supply, arbitrary expansion. The problem: the supply of currency is elastic. It stretches and contracts depending on political pressure and central bank discretion. When recession occurs, if stimulus is needed, the central bank's tool is the printing press. The result: the value of every dollar you own is continually under threat from the future expansion of the money supply. This is a system of limitless risk. The core flaw: the rules can be altered. The policy is mild. Mechanism 2. The Bitcoin supply, fixed contraction. The process: approximately every 4 years, the reward granted to miners for safeguarding the network, the quantity of new Bitcoin, is cut exactly in half. This is the halving. The result: the issuance rate of new supply is mathematically decelerating, approaching zero. As demand increases against a supply that is becoming geometrically scarce, the pressure on the price is only upward. This is a system of finite certainty. The core strength: the rules are hard-coded. The policy is mathematically immutable. This is the main distinction. The bank is related to fiat supply, a system of political convenience. Bitcoin is related to the halving, a system of mathematical necessity. Scarcity produces assurance. Certainty is worth it. The psychological barrier to belief. Why do people still struggle to grasp this? Because they have never encountered actual financial scarcity. They conflate volatility with danger. They observe the price bounce up and down by 20% and assume the asset is untrustworthy. They ignore the fact that the underlying rules of issuance have never altered. They mix the noise of the market with the signal of the protocol. Your attention must shift. Stop looking at the ticker price today. Start focusing on the supply curve tomorrow. The halving is not a forecast. It is a schedule. It is a predetermined, auditable reduction in supply pressure. This hard-coded discipline is the greatest cure to the inflation tax we outlined in Chapter 2. Inflation is soft money that can be continually created. Bitcoin is hard money that cannot be created beyond the 21 million wall. This is why you must adopt a long-term, sovereign accumulator mindset. You are not buying a stock. You are getting a piece of verified digital scarcity. The real-world behavioral instruction. Your objective is to implant this sense of scarcity into your own actions. You must quit waiting for the perfect price or the perfect moment. The perfect moment to acquire scarcity is always now. Instruction: automate your accumulation schedule. Stop speculating. Do not try to time the market movements. This is a fool's errand and a distraction from the ultimate purpose. Define your DCA, dollar cost averaging. Establish a non-negotiable, recurrent weekly or bi-weekly purchase of Bitcoin. This eliminates emotion from the equation. Automate the process. Use your exchange or provider to automatically execute the trade. The money leaves your bank and the Bitcoin is acquired on a schedule that you do not tamper with. By automating, you are adopting the discipline of the protocol. You are signaling to the market, I believe in the fixed supply, and I refuse to be distracted by short-term price movements. You are transitioning from a speculator who chases immediate profit to an accumulator who values long-term certainty. The most successful people in this field are not merchants, they are accumulators. They realized the force of the 21 million wall and simply positioned themselves against it. They knew that Bitcoin's greatest attribute is not its price, but its inelasticity of supply. Scarcity produces assurance. Certainty is worth it. You have the most powerful economic truth on your side. Maths over politics. Immutable code versus arbitrary edict. You have internalized the necessity of scarcity. You are ready to accumulate. But the final barrier to actual possession is physical, the holding of the key. You cannot be sovereign if you rely on a third party to store your key.
5. Own your private keys. If you don't hold it, you don't own it. You have seen the system's decline. You have calculated the inflation tax. You realize the power of utter scarcity. All of that information is pointless if you fail this solitary, non-negotiable test of sovereignty. The ultimate differential between a financial master and a financial hostage is one thing: custody. If you obtain Bitcoin and leave it on an exchange, you have learned nothing. You have just traded a cushy, slow-moving bank for a possibly fragile, faster-moving custodian. You have assigned your power again. You must internalize the sacred motto of our movement. It is the only norm that matters when addressing digital assets. Your keys, your money. Not your keys, not your money. The illusion of exchange safety. When you leave your Bitcoin on an exchange, Coinbase, Kraken, Binance, any of them, you are still trusting a third party. They have the private keys. They are the custodian. You have an entry in their database that states you own Bitcoin, but if the exchange fails, or if it is hacked, or if it is shut down by a regulatory authority, you are directly in line as an unsecured creditor. You are back where you started, reliant on the consent and the solvency of an intermediary. This is why the difference between a bank and an exchange is merely a matter of degree. The underlying risk of centralized power continues. The only way to eliminate that counterparty risk, the danger that another party fails you, is to become your own bank. This requires you to own your private keys. This is the physical and philosophical point of no return. You shift from spectator to sovereign. The mechanism of sovereignty: cold storage. The solution is not complex, but it demands discipline and accountability. It is called self-custody, specifically using cold storage. Cold storage is a device, a hardware wallet, that stores your private keys offline. These keys are the cryptographic passwords that authenticate ownership and allow you to spend your Bitcoin. When those keys are never exposed to the internet, they are virtually immune to remote hacking. This is your new vault. This is the castle where your verifiable scarcity eventually lives. Your keys, your money. Not your keys, not your money. Instruction: the 3-step immediate setup. This is the behavioral transformation that must happen immediately. Do not delay. Step 1. Acquire a reputable hardware wallet. This is your most crucial financial buy of the decade. Do not utilize inexpensive, unconfirmed devices. Purchase straight from the manufacturer. You are buying security. Do not compromise on quality. Step 2. Generate the seed phrase, the key to the kingdom. When you initialize the gadget, it will generate a sequence of 12 or 24 unique, random words. This is your seed phrase. This phrase is the fundamental necessity of self-custody. Step 3. Master the redundancy protocol. This is where most people fail. They write it down on a piece of paper and forget it in a drawer. You must safeguard this term physically and redundantly. Write it down legibly. Use metal stamping or a sturdy, fireproof material.
Do not store it digitally, ever. Store it in many independent, secure physical locations. One place must be fireproof and water-resistant. Your healing depends on this physical discipline. Test your rehabilitation plan. Do a dry run. Wipe your device and practice restoring it using only your seed phrase. Do this before you send a big sum of Bitcoin to it. The security of your riches is increasingly a matter of physical diligence. This is the burden you must take to gain freedom. Responsibility is the price of freedom. The fear of losing the keys is the #1 reason people refuse to take this step. They say, "I'd rather trust the exchange." This is the ultimate surrender. You are preferring the certainty of degradation, inflation risk, above the duty of control, key management. I am telling you, embrace the responsibilities. Mastering the hardware wallet is no tougher than managing a bank account password and a debit card PIN. The consequences of failure are severe, but the payoff is total, verified financial freedom. You are removing yourself from the chain of human trust and placing yourself in the chain of mathematical proof. If you are an owner, you hold the keys. If you are a customer, they hold the keys. The difference is dramatic, absolute, and defines your future financial reality. Your keys, your money. Not your keys, not your money. Let that resound in your thoughts every time you consider leaving your riches vulnerable on a third-party server. You have internalized the terrible realities of custody. You know what you must do to attain sovereignty. Now we must fight the psychological anchors that keep you linked to the old, deteriorating system. We must fight the ingrained lies.
Chapter 6. The Tyranny of the Default. Challenge your childhood programming. You have the roadmap. You know the mechanics. You realize the peril of delegation and the power of keys. Yet many of you are still apprehensive. You are frozen not by technical dread, but by a deeper psychological obstacle. That barrier is the tyranny of the default. The simple, powerful notion that has been ingrained into you from childhood. Money goes in the bank. It is safe there. It is the only way. This conditioning is the most effective safeguard the legacy system has. It inhibits the majority of people from even contemplating an option. It is not logic, it is cultural dogma. We must vigorously confront this innate bias. We must discard the programming, challenge the default, define your own truth. The comfort of the crowd. Think back. When you received your first birthday money, your parents told you to put it in savings. When you got your first paycheck, the HR department asked for a direct deposit to a checking account. Every movie, every news broadcast, every family talk repeats the same message. The bank is the baseline. This is the cognitive default. It is comfortable because everyone else is doing it. But comfort is the enemy of growth. Comfort is the engine of the inflation tax. Comfort is the feeling you receive just before the system fails you. The default option is never designed for your own autonomy. It is optimized for the system's stability, and the system's stability rests on your passive involvement. You must stop associating familiarity with security. You must cease confusing the majority's choice with the correct choice. The bank is the default setting for money management. Bitcoin is the sovereign decision. It involves effort, education, and the confidence to stand apart from the pack. Challenge the default. Define your own truth. The emotional anchors. Your financial decisions are not totally rational. They are greatly influenced by emotional moorings entrenched in your past. You must recognize these anchors and cut them loose today. We are going to undertake a psychological audit. Instruction. Identify 3 emotional money habits. Take a moment and reflect about the emotional lessons related to money from your earliest years. Identify 3 distinct, emotionally charged habits or attitudes. The fear of risk. Parental advice. Did your parents live through a depression or a financial scare?
Did they promote total safety, the never invest or never borrow mentality? This may drive you to arbitrarily choose a 0% interest savings account over any asset that exhibits volatility, even if that asset offers protection against the 5% inflation tax. You are selecting the guaranteed steady loss over the opportunity for big growth. The idolization of liquidity. Have you been conditioned to feel that money must be readily accessible for any perceived emergency? This overemphasis on rapid liquidity forces you to retain enormous sums in cash. The truth is, actual emergencies are rare, while the certainty of inflation is daily. You are selling long-term wealth preservation for short-term, low-probability convenience. The shame of failure. Do you fear that if you try something new, like self-custody or acquiring Bitcoin, and the price lowers, you will look silly or prove your parents right? This fear of being wrong paralyzes action. You are letting the fear of condemnation control your financial future. These are your anchors. These are the weakest places in your decision-making armor. They are not rational financial arguments. They are emotional protection mechanisms. Rewriting the code. To obtain sovereignty, you must commit to rewriting these 3 scripts. You must actively replace the old, rotting programming with the new, resilient, sovereign code. For every detected habit, you must commit to a new, declarative financial truth. Rewrite 1. From safety first to sovereignty always. Old script. Never risk capital. Safety means low-yield savings. New script. I will accept calculated, informed risk to preserve my wealth against the certainty of inflation. Control is the only safety. Rewrite 2. From cash is king to scarcity is king. Old script. All cash must be instantly liquid for emergencies. New script. My long-term wealth preservation is protected by provable scarcity. My working capital is maintained liquid. I isolate my finances and optimize my time in the rare asset. Rewrite 3. From fear of judgment to commitment to truth. Old script. I will only invest in things my financial advisor or friends recommend. New script. I define my own truth. My due diligence is complete. I put my long-term financial freedom over the short-term judgments of others. The act of defining your own truth. This chapter is about overcoming inertia. It is about the courage to perform the steps we have previously outlined. You know you should take custody of your keys. You know you should put the dollar-cost average into scarcity. But the default whispers, wait, be safe, check with an expert. The default is the enemy of action. Your transformation is built on a single powerful choice. Do you continue to live by the rules handed down to you by a decaying system? Or do you install a new operating system based on mathematical truth and personal control? You must make the choice to be financially autonomous. You must consciously choose to be the one accountable for your own keys, your own knowledge, and your own future. The default is the path of least resistance. The Zenith voice demands the road of most resistance, because that is the path to ultimate value. Challenge the default. Define your own truth. You have effectively broken the psychological bonds of the past. You are ready to manage your wealth actively. Now, we must identify the position that Bitcoin plays in your overall financial strategy. It is not only a tradable asset, it is something far more fundamental.
Chapter 7. The Bitcoin Battery, Your Emergency Liquidity Protocol. You have attained psychological independence. You have broken the programming of the financial default. Now we must identify the ultimate function of Bitcoin in your life. You must stop treating it as solely a tradable asset, a digital stock you buy and sell. Bitcoin is something a lot more basic. It is your personal reserve asset. It is the Bitcoin battery.
Every sound business, every stable nation has a reserve asset, something that is limited, non-dilutable, and trusted globally, a stable repository of captured economic energy. On your personal balance sheet, Bitcoin performs this job. It is an ultrasound method for keeping the energy of your past labor, protecting it from the policy degradation of the future. Bitcoin is your battery. Fiat is your fuel. Never combine the two functions. The energy storage problem. Think about your fiat currency, your dollars. In Chapter 2, we developed the inflation tax. Fiat currency is continually bleeding energy. It is like trying to store electricity in a rotting, damaged battery. The energy you earned yesterday is 3.5% weaker today. This is a fundamental weakness in the storage media. Bitcoin fixes the storage problem. It is a superb, sealed battery. The 21 million wall, Chapter 4, guarantees that the container itself cannot be extended. It can only hold the energy that is charged into it. The value you load into Bitcoin is the economic energy you captured through your time, risk, and discipline. When the dollar weakens, when the money supply expands, the value stored in the fixed supply of the Bitcoin battery is enhanced. This is why you must prioritize this view. Bitcoin is a store of energy, not a speculative trade. Bitcoin is your battery. Fiat is your fuel. Instruction. The Absolute Segregation Protocol. Your immediate instruction is to implement the Absolute Segregation Protocol. You must ruthlessly split your capital based on its intended function. Most people fail because they treat their whole wealth stack, from checking account to retirement fund, as one undifferentiated mass. They try to pay a debt with an investment or save for the long term in a checking account. This is financial chaos. Function 1. The fiat checking account, the fuel. Purpose. This is your short-term, high-velocity capital. It is the inevitable friction of daily living, paying the mortgage, covering utilities, buying groceries. Size. Maintain a maximum of 3 to 6 months of absolute living expenditures here. This is your operational fuel. Rule. Accept the inflation tax on this money. It is the cost of liquidity. Do not try to invest it and do not save long-term in it. Function 2. The Bitcoin stack, the battery. Purpose. This is your long-term, non-dilutable wealth preservation capital. This is the battery that retains your captured energy for the next decade and beyond. Size. Every dollar above the 6-month operational level must be deliberately put into the stack, utilizing your dollar cost averaging plan, Chapter 4, and placed into cold storage, Chapter 5. Rule. This money is untouchable. It is a reserve. It is not for paying bills. It is not for market trading. You access it only in the event of a severe financial emergency, when you need to transform stored energy back into liquid fuel. When you mix these functions, when you use your Bitcoin stack to pay an ordinary payment or try to utilize your checking account as a savings vehicle, you breach the protocol. You confuse the long-term hedge with the short-term transactional requirement. The Emergency Liquidity Protocol. If Bitcoin is your battery, how can you access that stored energy in a true emergency? This is your Emergency Liquidity Protocol. Define a true emergency. This is not a vacation, a new car, or a market dip. A true emergency involves a job loss, a medical crisis, or a fundamental threat to your family's shelter or health. The extraction. If the fiat fuel, the 3 to 6 months in your bank account, is totally drained, you then draw from the battery. You do not liquidate the entire stack. You compute the minimum quantity of energy needed. The recharging commitment. Crucially, the moment the situation is stabilized, your major financial priority is to replenish the battery. You pledge to replace the extracted Bitcoin immediately. The battery must recover to its previous capacity. This rigorous technique reduces the emotional trigger of selling. You are not selling a speculative asset. You are transforming stored energy back into liquid fuel to endure a storm. Bitcoin is your battery. Fiat is your fuel. The battery delivers the ultimate non-dilutable safety net that is wholly outside the financial system's authority.
Stop chasing transactional speed. People sometimes disregard Bitcoin because they claim it's too slow to buy a coffee. They are missing the idea altogether. They are demanding that the battery also operate as the fuel. Bitcoin's principal function is settlement and storage. The speed of the base layer is a feature of its security. It takes time to execute transactions because the network is conducting the complicated, energy-intensive task of safeguarding the 21 million wall. You need your vault to be slow, deliberate, and secure. Daily small-value transactions belong on the quicker secondary layers, the Lightning Network, which we shall touch on later. But for your major wealth capital, the core chain's gradual, secure settlement is what you demand. You are a sovereign accumulator. Your goal is not to spend Bitcoin. Your job is to maintain and protect economic energy. By adopting the battery and fuel procedure, you have made the final, decisive step toward financial organization. You have a purpose for every dollar you own, segregated and secured according to its function. You have clarity. You have control. You have the battery. You have segregated your long-term storage from your short-term spending. Now we must battle the internal impulse to destroy your own hard work, the incessant clamor of the market. You must learn to overlook the volatility that keeps most people poor.
Chapter 8. Ditch the noise. Focus on the accumulation schedule. You have set your financial basis. You have secured your wealth with the Bitcoin battery protocol. Now, we face the most typical failure point for people who transition to sovereignty: the noise. The market buzz, the social media experts, the 24-hour price updates. They are all designed to stimulate your emotional response. They exist to draw you out of your approach and back into the pit of reactive trading. The biggest adversary of the sovereign accumulator is not the bank, not the government, but your own unrestrained fear. You must learn to ruthlessly ditch the noise. Your focus must concentrate onto one single strong strategy: the accumulation schedule. The reality is clear, absolute, and proven. Time in the market beats timing the market. Always stack. The volatility trap. Bitcoin is volatile. It always has been, and it will be for the foreseeable future. Its price might fluctuate 30% in a week. This is an undeniable reality. But here is the lesson you must internalize. Volatility is meaningless to the long-term holder. Most people regard volatility as risk. The sovereign accumulator considers it as a feature. Volatility is the price you pay for access to the rare, non-dilutable asset. Chapter 4. It is the system that shakes out the weak hands, the speculators, the visitors, the undisciplined. If you are a long-term accumulator, your purpose is not to sell when the price is high. Your goal is to accumulate the asset itself. You are not playing the dollar game. You are playing the Bitcoin unit game. When the price reduces, the battery is on sale. When the price rises, your conviction is proved. Either way, you stick to the plan. Ditching the noise involves rejecting the psychological assault performed by the market. You are not a trader. You are a builder of wealth. Builders focus on steady effort, not daily variations. Time in the market beats timing the market. Always stack. The discipline of dollar cost averaging, DCA. Your only command for this chapter is the deployment of a non-negotiable dollar cost averaging technique. DCA is the discipline of making little, consistent purchases regardless of the current price. It is the single most powerful instrument you have to combat your own emotional inclinations and the market's noise. The math of DCA. DCA works by averaging out the cost of your purchases. When the price is high, you buy fewer units. When the price is low, the volatility feature, your set dollar amount buys more units. Over time, your average purchase price is averaged out, greatly minimizing the chance of buying the absolute peak. This method transforms volatility from a threat into an opportunity.
It is a commitment to the notion that Bitcoin's value will increase over the long term due to its proven scarcity. You are making a statement with every purchase. I believe in the protocol, not the hype. Instruction: implement the non-negotiable schedule. This is not a proposal. This is a command. Your life as a sovereign accumulator rests on this quick action. Step 1. Define your financial commitment. Determine a predetermined dollar amount you can easily and consistently contribute from your income to your wealth capital. Chapter 7. This amount must be non-negotiable. $100 a week, $500 every 2 weeks. Whatever the figure, it must be cut out first. Step 2. Automate the purchase. Use your exchange platform to set up a recurring automatic purchase order. This is critical. By automating, you remove the human factor. You eliminate the emotional friction that makes you check the price and decide, maybe I'll wait for a dip. Stop trying to be smart. Let the machine execute the discipline. Step 3. Immediate cold storage transfer, the lockdown. This is the final critical step of the accumulation schedule. The moment the automated buy is made, you must take that Bitcoin immediately off the exchange and into your self-custody cold storage wallet. Chapter 5. This transfer has 2 purposes. 1. It reduces counterparty risk. Chapter 5. 2. It functions as a psychological lockdown. Once the coins are in cold storage, they become hard to transport. This physical barrier keeps you from making emotional, reactionary trades based on the market noise. Your major attention becomes the transfer receipt, not the present price. You focus on the growing quantity of units stored in your private vault. The true cost of timing the market. Those who try to time the market lose. They are continually moving in and out of the asset, trying to predict the unpredictable. They suffer from 2 catastrophic flaws. 1. They miss the enormous up days. The highest price gains frequently happen in a modest fraction of trading days. If you're sitting on the sidelines waiting for the ideal entrance, you miss the spectacular growth that defines the asset. 2. They accrue exorbitant fees and taxes. Constant trading raises transaction costs and creates complex tax responsibilities, further depleting their capital. The DCA accumulator, by comparison, is always in position. They are quietly, relentlessly capturing the value of the network's expansion. They are building the battery. They are ignoring the fire drills. Your commitment to DCA is a commitment to the long-term, non-dilutable nature of Bitcoin. It is the rejection of the high-friction, high-stress world of speculation. It is the way of the financially mature. Time in the market beats timing the market. Always stack. The volatility will always be present. Your discipline must be stronger. You have mastered the essential operational discipline. You have nailed down your accumulation approach. Now, we must lift the debate from digital gold to the full revolutionary potential of the asset. Bitcoin is not merely a better store of value. It is the infrastructure for a new global economy.
Chapter 9. Why digital gold is a low-value label, the transaction layer. You have protected your fortune. You have mastered your accumulating schedule. You have transformed from financial hostage to sovereign accumulator. But to properly appreciate the significance of your decision, you must remove the low-value label the media pushes upon Bitcoin. You keep hearing it termed digital gold. Stop equating a technology revolution to a commodities improvement. Bitcoin is not only better gold, it is not merely a greater store of value, but it is that. It is something much more powerful. The world's only censorship-resistant, verified transaction layer for the Internet of Value. This is a major infrastructure transformation. It's not just a store of value, it's the future of commerce. The limitation of gold. Gold is a tremendous store of value. It is scarce, durable, and recognized globally, but it fails totally as a transaction layer. Try to send $100,000 in gold bars from New York to Singapore. It is slow, It demands significant security. It incurs tremendous costs. It requires trusted third-party verification, insurance, and physical transfer. Gold relies on central vault custodians. It relies on the financial system we are actively opting out of. Bitcoin, by contrast, removes all these intermediaries. The Bitcoin network can settle that identical $100,000 transfer across the globe from your sovereign wallet to theirs in minutes for pennies without asking a single bank or government for authorization. Chapter 3. This capability, the ability to move vast wealth securely and permissionlessly, is what characterizes Bitcoin as a unique, powerful technology, not just a lump of digital metal. The problem of the base layer. Now we must address the valid criticism you hear about Bitcoin: speed. Critics point out that a base layer Bitcoin transaction might take minutes, perhaps an hour, to properly confirm. They scoff and wonder, how is that the future of money? The answer is layering. The Bitcoin base layer, the core blockchain where transactions are permanently recorded, is designed for security and final settlement. It is the global vault. You want your vault transfers to be slow, deliberate, and expensive enough to deter fraud. But just as the internet has layers, TCP/IP is the safe backbone, but email and streaming run on top. Bitcoin offers a solution for high-frequency, low-value transactions, the Lightning Network. Instruction. Understand the Lightning Network. Your instruction is to explore and comprehend the core capacity of this Layer 2 technology. The Lightning Network is a mesh network of payment channels built on top of the Bitcoin blockchain. Speed. Payments are near instant, settling in seconds. Cost. Fees are fractions of a penny. Scale. It can handle millions of transactions per second, eliminating the capacity issue that affects the base layer. Think of it like this. The Bitcoin base layer is the armored global freight train, slow, secure, transferring large sums of value across countries. The Lightning Network is the high-speed commuter rail, moving people rapidly and cheaply within the metropolis. The money on the commuter rail, Lightning, is settled and safeguarded by the armored freight train, Bitcoin base layer. The genius of this architecture is that it allows Bitcoin to be two things at once: a great storage of value, the battery, and a global, immediate, final settlement network, the transaction layer. Why this matters to your sovereignty. Understanding the Lightning Network alters your financial outlook from passive holding to active engagement in a new economy. If you are a business owner, this means fast, irrevocable payments from anywhere on Earth, circumventing the 3 to 5% fees and 3-day hold times of traditional processors like Visa or PayPal. If you are a globally mobile individual, it means sending money to family across borders for nearly little cost and with zero censorship risk. The current system relies on SWIFT wires and correspondent banks, a legacy from the 1970s. It is slow, hierarchical, and sensitive to geopolitical pressure. Bitcoin, leveraging Lightning, is peer-to-peer. It requires no correspondent bank, no central clearinghouse, and no license. This is the future of trade. This is the unstoppable money you have chosen to acquire. The commitment to utility. Your new commitment is to regard your collected Bitcoin stack not merely as a hedge against fiat deterioration, but as digital, functional infrastructure. When the price goes up, you are not just wealthy. You are carrying a greater portion of the only genuinely global, neutral payment rails. When you DCA, Chapter 8, and place your keys into cold storage, Chapter 5, you are not simply securing wealth. You are securing access to the future financial internet. Stop getting emotionally distracted by the price changes and start respecting the technology. Action step. Download a basic, Lightning-enabled, non-custodial wallet today. Send $10 worth of Bitcoin to it. Make one single low-cost Lightning payment to a friend or a merchant. Feel the speed. Witness the zero-permission transfer. You need to feel the utility. You need to encounter the future. Do not allow the trite cliché digital gold to lessen the power you wield. It's not just a store of value, it's the future of commerce. You now realize that Bitcoin is a dual-function asset, a powerful battery, and a limitless transaction layer. We have examined the technical necessity of the system. We have discussed the financial protocols. Now, in our final lesson, we must establish
The ultimate philosophical commitment, the final frontier of sovereignty. Chapter 10. Your final decision, the sovereignty threshold. This is your final chapter. We have peeled away the falsehoods of security, calculated the tax of inflation, and mastered the discipline of self-custody and accumulation. The option you confront is no longer technical. It is not about blockchain speed or price volatility. It is a significant philosophical and moral choice. The decision between the bank and Bitcoin is the decision between delegated control and ultimate self-responsibility. Most people choose delegation. They enjoy the comfort of having someone else to blame when things go wrong. The sovereign chooses responsibility. They recognize that freedom entails accepting the full repercussions of their acts. You must understand this essential truth. Responsibility is the currency of the sovereign. The philosophical divide. The legacy banking system is predicated on trust and delegation. You trust the institution. You delegate your control. You assign the management of your keys. You delegate your purchasing power. In exchange, you gain comfort and convenience. Bitcoin is built on verification and self-custody. You verify the protocol. You demand self-custody of your keys. You accept ultimate responsibility for your fortune. In exchange, you obtain censorship resistance and protection against policy degradation. The globe is rapidly separating into two financial classes: the delegated, those who rely on intermediaries and are susceptible to the soft rules of politics and central bank policy; the sovereign, those who rely on rigorous calculations and self-custody. Your last decision is just to choose whose side of the divide you belong to. You must look at your own balance sheet and declare, how much am I willing to be responsible for? Responsibility is the currency of the sovereign. The sovereignty threshold. Your immediate, final directive is to define your sovereignty threshold. The threshold is the particular percentage amount of your total net worth that you are willing to entrust to a system that functions fully outside the legacy government and central bank supervision. This is the line you draw between your fuel, fiat liquidity, and your battery, Bitcoin reserve. Most people feel sovereignty is an all-or-nothing effort. It is not. It is a gradual, systematic commitment. Instruction: calculate and commit. Define your net worth. Calculate your entire assets. Set your initial threshold. Commit to an initial percentage of that net worth that will be progressively converted to Bitcoin and transferred into cold storage. Chapter 5. Start small, but start today. For some, this might be 1%. For others, 5%. The non-negotiable start. The number does not matter as much as the commitment to action. You must make the first transaction today. You must make the beginning steps toward custody today. This initial deed shatters the barrier of inaction. The graduation protocol. Only boost your sovereignty threshold when you have successfully proven two things. You have mastered your cold storage, seed phrase backup. You have maintained a rigorous DCA schedule, Chapter 8, despite periods of turbulence. Do not increase the risk until you have shown your own discipline. Self-responsibility must precede self-sovereignty. The moral choice. Exit the lie. This choice carries moral weight since you are choosing to depart a system predicated on dishonesty, the inflation tax, and compulsion, the cost of permission. Every dollar you transfer from the bank into your own self-custody signifies a vote for sound money, for rigorous math, and for your own economic future. You are no longer subsidizing a system that deliberately depreciates your labor. You are no longer submitting to arbitrary financial censorship. You are appointing yourself as your own principal financial authority. This decision will feel awkward. It will feel lonely. That soreness is the friction of growth. That seclusion is the required severance from the herd. The majority is virtually always wrong when a paradigm shift is occurring.
This entire book has been a plea for you to quit being a passive beneficiary of financial policy and start being the architect of your own balance sheet. The finality of the key. The seed phrase we covered in Chapter 5 is the concrete manifestation of this philosophical commitment. When the bank holds your keys, you delegate the duty. If they lose your money, the loss is shared with all other depositors and insured, a diluted effect. When you hold your keys, the duty is absolute. If you preserve your seed phrase, you are protected internationally, irrevocably. If you lose your seed phrase, the loss is yours alone. This absolute consequence is what makes Bitcoin money for grown adults. It demands ownership of your future. It eliminates the ability to point fingers. You have the knowledge, you have the instructions. The only thing left is the resolution to act. Define your threshold, make the first purchase, take custody of the keys. Do not wait for certainty. Do not wait for the price to stop moving. Do not wait for permission. Act because you recognize that responsibility is the currency of the sovereign. You are ready. You have reached the end of the lesson, but this is not the end of your trip. The basic message is clear. Your money belongs where you control it. The bank promises you comfort at the cost of your control. Bitcoin provides you autonomy at the cost of your duty. The option is non-reversible. The inflation tax is guaranteed. The necessity for censorship resistance is developing constantly. You cannot afford to dwell in the past. Here is your immediate action step. Define your threshold right now. Then open your exchange, make your non-negotiable initial purchase of Bitcoin, and commence the transfer to your cold storage wallet. Stop begging for permission. Take custody of your power. This single act is the loudest proclamation of financial freedom you can make. Do not delay. Do not hesitate.
If this book offered the urgency and clarity you needed to alter your financial life, then share this knowledge. Subscribe to the Zenith Voice to ensure you continue receiving the high-value blueprints for improving your money and your thinking. The next important truth is waiting for you. But first, act.